Welcome to our webinar on the Corporate Transparency Act foundations. This is our overview course that goes through the basics of the CTA. We do have other specialized courses that we hold at other times throughout the month. You can go to our website at FinCENreport.com to get the full schedule. We have, for example, an advanced topics course that goes deeper into the weeds on some issues. We also have courses for real estate transactional practitioners and also for trusts and estates attorneys, going deeper into those particular issues. And this, of course, is the foundations course, the general overview. We're going to go through some of the background today on the Corporate Transparency Act and what you need to know to help your small business clients get through the BOI filing process. You can ask questions by putting your questions into the Q&A tab in Zoom. You can also get a copy of today's slides and a copy of the recordings. If you request a demo of the software, you can do that by going to the chat function and clicking on the link in there to request a demo. That's how we can get you to the slides. So let's begin at the beginning. We're going to go over today the Corporate Transparency Act, key vocabulary terms like reporting company, the exemptions, and the definition of beneficial owners. And we're going to end up with, hopefully, a logical process that you can use to guide your clients through the process of filling out their first BOI reports. And as we get started here, again, my name is Jonathan Wilson. I'm the CEO and co-founder of the FinCEN Report Company. I'm also a practicing attorney with a law firm called Taylor English here in Atlanta. I spotted the Corporate Transparency Act as something that was going to be a challenge when Congress first passed it at the very end of 2020. We formed the company not long after that, and we got started putting together our filing system to help law firms guide their clients. The software is basically no charge to the law firms unless they also get this add-on piece called the Wizard. And what the software does is it allows you to guide your clients through the process in an orderly manner. It gives your law firm a dashboard and it helps you keep track of all your clients as they go. We're not going to do a demonstration of the software here today. This is not a sales call. This is all substance, but it's helpful to understand how the filing system works from FinCENreport.com and how it relates to the substance we're going to cover today. So, as you mentioned, the Corporate Transparency Act was adopted by Congress at the end of December 2020. It is formally an amendment to the Bank Secrecy Act, which was first adopted by Congress in 1970, been amended a few times since then. And FinCEN, the Financial Crimes Enforcement Network of the U.S. Treasury, was empowered to implement regulations to put the Corporate Transparency Act into effect. There are three separate rulemakings that FinCEN needs to complete. They have finished one, they're halfway started on the second one, and they haven't really started on the third. The one that they completed is the one that we call the final rule on beneficial ownership reports. It was issued in September of 22. It's been amended 2 times since then. And if you just Google 31 CFR 1010.380, you'll find the Government Printing Office or GPO version of the regulations. That's probably the best way for you to get into the topic if you haven't done that before. I see that some people have come loaded for bear with their questions already in their back pocket. I'm going to try to get to the questions as we go through the content. The final rule, 31 CFR 1010.380, became effective January 1, 2024. So those regulations are in effect today. And what the regulations require is that almost every company in the U.S. that is not exempt is going to file this BOI report with FinCEN. FinCEN is going to keep those reports in a big database in the sky that is mostly confidential. It will not be publicly available. It will be available to law enforcement, both at the federal and state level. It will be available to banks and financial institutions if they have the consent of the company itself, the company that filed the report. And in some situations, even foreign law enforcement is able to get access. It's that second topic, how entities get access, which is the rulemaking that I mentioned before that FinCEN has started. They have published a proposed access rule. That proposed access rule has not yet become final. The third aspect of the rulemaking that FinCEN needs to complete is the one that harmonizes the rules under the Corporate Transparency Act with the rules that banks are currently implementing when they have you fill out the KYC, or Know Your Customer form, every time your corporation opens a new bank account. At the moment, the definition of beneficial ownership and control in those two filing regimes, CTA and KYC, are out of sync. Part of the Corporate Transparency Act requires FinCEN to harmonize the two, and that's the piece that FinCEN has not yet started. But we're here to talk about the final rule for BOI reporting, and it is going to be fairly complicated, as you'll see. Attorneys are going to have to get up to speed on it, whether they expect that they're guiding their clients through the process or not. It's going to be an issue that comes up over and over again in our transactional practice, and most companies that are filing are going to need some form of assistance from professional advisors. So how does the CTA work? This is where the vocabulary words come into play. Every reporting company that's not exempt needs to file a BOI report that discloses 5 specifics of personally identifiable information, or PII, for each of its beneficial owners. Each of those bold and italicized words is a vocabulary term that is defined in the regulations. Entities that are formed on or before January 1, 2024 do not need to identify their company applicant. Only entities that are formed on or after January 1 have to identify the company applicant. Please do not submit a question that asks me, how far back in time do we have to go to find company applicants? If your company was formed before January 1, 2024, it never needs to know or find its company applicant. Now, once the company files its first report, it has only 30 calendar days in which to file an amendment if either the beneficial ownership should change, or any of those 5 pieces of PII for any of its beneficial owners should change. We'll get into some of those details later on. Filing on time is important because if you are late, there is the potential for a $500 per day fine, and a willful failure to file or a willful file of false information can be punished as a felony. Companies that were formed before 2024 have until the end of this calendar year to file their first reports. Companies that are formed on or after January 1, 2024 have only 90 days to file a first report. Next year, in 2025, that 90 days is going to become 30 days. By then, FinCEN expects that we're all going to know this stuff and we're going to be more efficient at getting it done. So, why should your firm be involved? Sometimes I have conversations with law firms that say, our executive committee got together and we decided that we're not going to be involved. It's still astonishing to me that law firms do sometimes reach that conclusion. I think it's not going to be a good position for them to take, and I think they're probably going to re-examine it. First, as attorneys, we have a professional and an ethical obligation to advise our clients on the law. If it's not something we know, we either need to get co-counsel that does know, or we need to get up to speed. But saying that there's a law out there and Mr. Client, you need to go figure it out, but I won't help you, it's just not going to be very effective for you if you're a transactional attorney. As I mentioned, knowing the CTA is not just a requirement for getting these reports on file, it's also going to be a prerequisite for a transactional practice. Whether you're involved in M&A or securities offerings, you need to understand how the CTA is going to relate to those types of transactions. And on a very practical level, if you don't give your client advice on how to deal with the CTA, they're going to get that advice from somewhere else. I don't think that people should be overly afraid of the CTA, but I do think that they need to take the time to get up to speed and be able to speak about these issues with clients. So what is a reporting company? Remember, every reporting company that is not exempt needs to file a BOI report. There are 2 types of reporting companies. You can either be a domestic reporting company or a foreign reporting company. You are a domestic reporting company if you are an entity formed in the United States by the filing of a document with the Secretary of State or a similar office under the laws of any state or Indian tribe. During this presentation, every time I refer to Secretary of State, just assume that I'm also saying or any similar office under the laws of any state or Indian tribe, because that phrase is included with Secretary of State every time it is used in the regulation. So among domestic reporting companies, we're dealing with all corporations, all LLCs, and anything else that is formed by the filing of a document. From almost every state, that's a limited partnership. In most states, general partnerships are matters of private contract. There are a few state law exceptions to that. In most states, trusts are matters of private contract. They are not reporting companies. One exception to that rule is the Delaware Statutory Trust, which does require the filing of a document with the Secretary of State. Those are the domestic reporting companies. The foreign reporting companies include any entity that is formed outside the United States that registers with a Secretary of State in order to do business. So if you are a UK corporation and you come to the US and you register in Delaware as a foreign corporation doing business in the state of Delaware, when you register, you become a reporting company for purposes of the CTA. Reporting companies that are not exempt need to file. There are 23 different categories of exemption. I'm not going to read these all out to you. You will need to take a look at the regulations in 31 CFR 1010-380 if you think that one of your clients might be exempt. If you are exempt, you do not need to file. You don't have to file a document claiming the exemption. If you are exempt, you do not file. However, you want to be sure to get that one right, because if you do not file, and it turns out you were wrong, now you have an entity that has failed to file, and that could be subject to penalties and even a concern of felony willful failure to file. And so that's why we want to get this right. So what is a beneficial owner? If you're a reporting company, you're not exempt, therefore you have to file. The reporting company has to identify every beneficial owner of the company. The beneficial owner is an individual that meets either test. Either they own, directly or indirectly, 25% or more of the ownership interest in the company, or they are an individual who exercises substantial control. Each of these two concepts, the percentage ownership and the substantial control, are defined terms in the regulations. You're going to want to read those regulations to make sure you can apply them. Importantly, the definition of beneficial owner in the CTA is very different, as I mentioned before, from the KYC regulations that banks apply in their KYC forms. So you might have been an individual who signed the KYC form for the bank and not be a beneficial owner under the CTA, or vice versa. You're going to have to do the analysis from the ground up. Calculating ownership percentages. Remember, you're a beneficial owner if you fall under either one of those two prongs of the test. When we calculate ownership percentages, we don't just make a guess. We don't just round things off. FinCEN has given us some very specific rules about how to calculate ownership percentages. The first is the present time rule. We calculate percentages at the present time with any options or similar convertible interests being treated as exercised. So an individual who owns common stock in a corporation and who also has a convertible promissory note convertible into stock, you're going to treat that note as if it is converted. An individual who has stock and also some options, we're going to treat the options as if they have all been exercised, even if they are not vested. That can change the math in some close cases. Next, you have to look at your reporting company and ask yourself, is this an entity that is a corporation that issues stock, or is it taxed as a partnership for federal income tax purposes? If it's taxed as a partnership, you apply the partnership capital rule. If it is a corporation, you apply the corporate capital rule. Both rules reach a relatively similar outcome, but you have to follow a different logical path to get there. And it's important that you follow that path because in some edge cases, it can make a difference. If you are a partnership, you are supposed to calculate the total capital and profit interests of the entity, and then determine what percentage of that combined capital and profit interests each individual would get. Now, for my friends who are tax lawyers, this hurts your brains. My tax lawyer friends tell me we don't deal with profits interests and capital interests in an amalgamated fashion, as if they're all one thing and then divided up by percentages. We would have percentages of capital interests in one portion of the operating agreement, and we would treat profits interests differently. I'm sure you're absolutely right for tax purposes, but that's not what the CTA regulation says. The CTA regulation says that you have to take everything all together, capital and profits interests, and then allocate it amongst all the various members to see who would have 25% of that entirety. When you do this, one of the things you realize is that if you have a reporting company that has a waterfall in it, in which some members get so much at this percentage until this happens, and then these members get so much at this percentage until that happens, what I would call a multi-level waterfall. In many situations, when there is a multi-level waterfall, you can't actually do the math because the assets of the company are not known down to the penny. So we can't actually run the math, as it were, on a spreadsheet. When that happens, we conclude that the application of the partnership capital rule does not lead to a reasonably certain outcome. Reasonably certain is the language from the regulation. If the partnership capital rule doesn't lead to a reasonably certain outcome, then you apply the fail-safe rule. The fail-safe rule, and again, this is taken right out of the regulations, says that if the outcome is not reasonably certain, you need to treat as a beneficial owner any individual who has 25% or more of any class or type of security. Well, in the case of a partnership, which could be an LLC taxed as a partnership, what is every class or type of security? Well, we just talked about the multi-level waterfall. Persons who have a percentage at one level of the waterfall have a different percentage at a different level of the waterfall. I think the prudent interpretation is to treat each level of the waterfall as if it is its own type or issue of security and calculate 25% at each one of those levels, so that an individual who might have way less than 25% of the entire company could be a beneficial owner if they have 25% or more of any level of the waterfall, if we are applying the fail-safe rule. So I've just dealt with subsection B and subsection D as they relate to entities taxed as partnerships. Let's also talk about the corporate capital rule. If your reporting company is one that is a corporation that issues stock, that's the key that's used in the definition of the regulations, then we must treat as a beneficial owner any individual who has either 25% or more of the voting stock or 25% or more of the total combined value of the ownership interest in the company. What does total combined value mean? That's a phrase that we didn't have in corporate law before now. Well, I think total combined value is corporate speak for the total of all the capital and profits interests of the entity. Since in a corporation, you wouldn't have separate capital and profits interests. Again, in a corporation, if you have a corporate structure that has multiple levels of waterfall, such as a corporation has common stock and preferred stock, or even multiple classes of preferred stock, you are going to run into the same problem where the outcome might not be reasonably certain. It's not reasonably certain if you don't know the liquidation value of the company to a reasonable certainty. So in that case, if your application of the corporate capital rule doesn't give you an outcome that's reasonably certain, you have to apply the fail-safe rule the same way we just described for partnerships. Now, I have a few examples that we're going to get to later on in the presentation, so I'm going to skip over that for now. And this is what I call the decision tree. Just a graphic that you can use to describe the process you go through. You might find this helpful if you are leading the task force at your law firm, figuring out how you're going to apply the CTA, or if you need to apply this and explain it to a client. After you have figured out all of the individuals who are beneficial owners by virtue of ownership, you next need to go and calculate who are also beneficial owners by virtue of substantial control. Be careful. An individual can be a beneficial owner by virtue of substantial control, even if they don't own anything. Ownership has nothing to do with substantial control. The FinCEN regulations tell us that an individual exercises substantial control if they trip any one of the 4 prongs of this test. They are: 1, if they serve as a senior officer of a reporting company. Senior officer is a defined term in the regulation. Senior officer is defined as any CEO, president, COO, chief financial officer, general counsel, or other person serving a similar role regardless of their title. So it's not the title that matters, it's the function. The person functions like a senior officer, then they are one, then they are a beneficial owner. We also must include anyone who has a power of appointment, either the power to appoint any senior officer or a power of appointment over a majority of the board of directors. Subsection C is the one that gives everyone fits. You are a beneficial owner if you direct, determine, or have substantial influence over important decisions made by the reporting company. What does substantial influence over important decisions mean? Unfortunately, that phrase is not defined in FinCEN's regulations. We have a non-exhaustive list here of the 7 different types of things that we know are major decisions or important decisions, but we don't really have a definition for substantial influence. Well, we know that substantial influence is something less than a veto. You don't have to have a veto in order to have substantial influence. In my book, the prudent rule is to treat anyone who has a seat at the table for making these important decisions as a person who has substantial influence. They have influence if they have a vote. Their influence is substantial if their vote is meaningful. So, for example, in our LLC operating agreements, we might say that the LLC has 10 different members. One of the members is the manager, makes all the day-to-day decisions. But in the case of a major decision, we're going to require a vote of all the members, and we're going to require a majority consent in order to have that major decision enacted. In those types of situations, I think that every one of the members becomes a beneficial owner by virtue of substantial control because they have a vote on that important decision. Now, that's my conservative approach. It's important to realize that as an anti-money laundering law, the Corporate Transparency Act doesn't give you any safe harbor to exclude anyone. If, with the benefit of hindsight, FinCEN determines that someone had substantial control, that becomes an issue if they were not covered by the BOI report. So, in my book, the prudent rule is to include, as a beneficial owner, anyone who has a vote on major decisions, which could include all of the members of your LLC in a situation where the operating agreement provides for a majority vote. I think it also includes every member on a corporate board of directors. The corporate board is going to make major decisions. All the board members are going to get to vote. And for that reason, I would include them all. Be careful. FinCEN on its website has a series of FAQs. And they have an FAQ that reads something like, is it true that every member of the board of directors needs to be included on the BOI report? The answer they give is no. You only need to include a person if they have substantial control. In my view, that answer is true, but misleading. Yes, persons only get included if they have substantial control. But how can you have a member on a corporate board who does not have substantial influence over important decisions? I think every member of a corporate board has substantial influence over important decisions. So for that reason, my advice would be to include all of your board members. Subsection D on the slide is what I like to call the Tony Soprano test. If you remember the Sopranos, they had that Italian restaurant that they always went to. Tony treated it like he owned the place. His name wasn't in the corporate records. He wasn't a shareholder. He wasn't on the board of directors, probably didn't even have a board of directors, but he had a key to the front door. He could take cash out of the till anytime he wanted to. He treated it as if he owned the place. He would often come in at all hours of the day and nights and have meetings in the back. Well, if that entity were a reporting company, I think that they would need to include Tony Soprano under subsection D as an individual who has substantial control. And it's precisely that sort of off-the-books control that FinCEN is trying to get with subsection D. Because this is an anti-money laundering law, FinCEN knows that there are going to be bad actors that try to get around having their names reported, sometimes using titles or keeping their names off the books in order to disguise their true relationship. That's precisely the sort of arrangement that FinCEN is trying to flesh out with this prong of the definition. So if you encounter a reporting company that has a player involved who has that level of control, even if they don't own 25%, even if they're not a senior officer and not on the board, I would encourage you to consider whether that individual needs to be named as a beneficial owner. So your decision tree then is for each company. Is it a reporting company? Is it exempt? If it is exempt and it's a foreign pooled investment vehicle, there's a special rule for that. Crack open the regulations. Foreign pooled investment vehicles are very rare. There's only about 4,600 of them in the United States, so you probably won't meet one. If your entity is not exempt, then you go through the test to calculate beneficial owners by virtue of ownership percentage. After that, you add to it all the individuals who are also beneficial owners by virtue of substantial control, and that's your list of all your beneficial owners. If your entity was formed before 2024, you do not need to list the company applicant. Entities formed on or after January 1, 2024 do need to include the company applicant. This is the decision tree that I just described. Again, this is a good graphic that you can use either when you explain this to your colleagues or when you explain it to clients. Now let's talk about the data that is required to go into the BOI report. You can take all the data and basically divide it into two different piles. There is company data, and then there's the PII for the beneficial owners. For the company data, we need the company's full legal name, state of organization, any trade names or DBAs, a current street address for its principal place of business. This must be its business address in the United States. It cannot use an address from outside the US. We also need to know the taxpayer identification number, or EIN. One of our questions we have is, if the EIN for a new company is not received by the deadline, what are the options? The answer is that there are no options. One of the things we need to keep in mind when we're forming new entities is that we need to apply for that EIN right away. In my practice, we're usually able to get the EIN within 24 to 48 hours. The IRS has an online tool for that. So I would recommend using that tool to get your EINs. For what it's worth, I've also come across the problem of entities that are disregarded for tax purposes because they are wholly owned by another entity that is usually a partnership. And often that disregarded entity does not have an EIN. At the moment, there is no way to file a BOI report that misses or that omits the EIN. FinCEN just won't let you file. I have tried to certify the question to FinCEN's help desk. Unfortunately, they just aren't answering questions anymore, and you get a robot answer back from FinCEN. So my advice, if you have entities formed in 2024, get the EIN early. Even if it's a disregarded entity, get the EIN anyway, because you're going to need it in order to file on time. Next, for each beneficial owner, you need to know their full legal name, date of birth, their residential address, not the business address, and then the unique identifying number, which can either be the driver's license or the passport. If the individual does not have a driver's license or a passport, you can use a non-expired foreign passport. If the individual does not have any one of those three pieces of information, you are in a world of hurt because FinCEN's regulations do not contemplate the possibility that an individual has neither a driver's license nor a US nor a foreign passport. I'm aware of situations involving undocumented immigrants to the US that have formed businesses that exist and are paying taxes, which is a great thing. But those individuals are unable to file because the individuals lack a compliant form of documentation. For counsel involved in those, reach out to me privately, jwilson@fincenreport.com, and I can connect you with another practitioner in this space who's working on a solution for that. If your company was formed during 2024, you need to identify the company applicant. And for each company applicant, include the same information, provided, however, that if the company applicant is in the business of forming companies, we do not need to disclose their home address. They may use a business address. Company applicant. I'm not going to dig into this too deeply. The company applicant is defined as the individual who directly files the document with the Secretary of State that forms the entity. If you help a client and you give the document to a corporate service provider and service provider files the document, it is the employee of the service provider who is the company applicant. If you're an attorney, you work on the articles, you hand them to the paralegal, your paralegal then files the document with the Secretary of State. It is the paralegal who is the company applicant. In addition, if there is more than one person involved in preparing the document that gets filed with the Secretary of State, in addition to the individual who directly files the document, who is the first company applicant, there must also be a second company applicant, which is the person who is primarily responsible for directing or controlling the actions of the first person. Now, a few weeks ago, law firms were bending over backwards trying to avoid having their attorneys named as company applicants. That will not work anymore. If you go to FinCEN's website look at their FAQs. Go to FAQ E5, and it gives you several different scenarios about who is the company applicant. As you'll see from those scenarios, it's not possible to contract your way out of being the company applicant. If you are one, you are, and your information will need to be included in the BOI report. So, most law firms have a CTA task force or a team that is guiding all the clients through the filing process. My hope is that they have an organized process for going one by one through each reporting company, collecting all the constituent documents. I list some of them here on the slide. Any voting trust agreements, shareholders agreements, other side agreements that might affect decision making. Collect a list of all the senior officers, collect a list of all the board members, get a list of investors, what we call a cap table, and that is the information that you're going to need to apply all the tests that I've taught you about so far. Make sure to get the EIN, get it early so that you do not run up against a deadline. For companies that don't need to file until the end of the year, you do have some time to make some changes in corporate governance if needed. You might consider adopting a CTA compliance policy and appointing a CTA compliance officer to head up the work. I authored the text inside of the LexisNexis Practical Guidance form. All of my templates are inside of LexisNexis Practical Guidance, and you can find them there. And you should work on a messaging a program to your clients along with a timeline. If everybody waits until December to try to file these things, it's not going to work. There just won't be enough billable hours in the month. We need to get started. It's not a crisis here in the middle of February, but it's going to become urgent soon. So people should get this process underway. Managing all this information is going to be a challenge, even for small and medium-sized law firms. Having a handful of paralegals with a great big spreadsheet is not a good plan because even if you collect all the information right in the first instance, you don't have any system for keeping track of changes. If you file that first BOI report and then a month later, one of your beneficial owners gets a new residential address, how are you going to know? How is that data going to get into your spreadsheet? And how are you going to be able to alert the client in time for the client to file the amendment to their BOI report within 30 calendar days of the event occurring? You just can't do it. That problem is what is at the heart of our FinCENreport.com filing system. We keep track of those deadlines and we provide automated reminders and responses when an amendment is due. If you want to give it a try, you can do so for free. Just go to FinCENreport.com, click on the button that says Get Started, enter your email address. Again, this is all free. We're not even going to ask for a credit card. But by giving us the email address, you're able to create your own free account and play around with it, see how the software works. If you think that you want to use it with a law firm, click on the link to get a demo of the software that is in the chat function in Zoom. One of my colleagues will reach out to you. The way our system works for law firms is we give you this dashboard like what you see here that allows you to organize your team inside your law firm and then organize all of your client reporting companies, all of which are accessible through the dashboard. Inside the dashboard, you can see all the companies. As you can see, each company name is its own hypertext link. And when you click on that link, you then go to the company file, which is where we collect all the information about the company. We also then connect the company to all of its beneficial owners. Each beneficial owner creates their own personal account that is free. That's where they put their personal data along with their driver's license and their passport. That's what keeps it confidential and secure. When all the information is ready, that's when the individual, the company, is able to file the report. The system is going to extract the confidential PII from each beneficial owner's account, insert it into the report, file it with FinCEN, and no other individual is actually going to put their eyes on the PII of those individuals. Then, after the company files, if any individual's beneficial ownership information should change, that is going to trigger a flag inside the company report and also inside your partner dashboard, so you can remind your client that they need to file the amendment. Since the fees for the amendment can be, rather the fines that FinCEN imposes are $500 a day, preventing you from being even 1 day late on a filing could be very valuable, more than the amount of the filing fee. As I mentioned, all these individual accounts are free. Your account working with clients is free. The reporting company is going to pay a $199 annual subscription. That doesn't apply until they actually press the button to file that first report. So all of the precursor work, all the preparation work is free. Once they pay the $199 and the first report goes through, that covers the first year of service. If a beneficial owner should change and the flag goes up that you need to file the amendment, the reporting company is able to file that amendment simply with a click of a button at no additional charge. Unlimited amendments are included in the $199 fee. So let's dive into some examples about how we're going to apply these rules to help our clients as we go. Example number one is always the easy one. Larry, Bill, and Sally form a corporation, each get 1,000 shares of stock. Larry's the CEO, Bill is the CFO, Sally is the head of marketing. Each of the three are members of the board of directors. So who are the beneficial owners? Should be easy, right? It is. Purely on the basis of ownership, each of the three of them has a third. The outcome is reasonably certain because those percentages don't change, whether this company is worth $1 or $1 billion. So all three of them are beneficial owners. But we don't stop there. We still have to go through our substantial control analysis. In this case, Larry and Bill are both senior officers, CEO, CFO. Sally is not a senior officer, so those two would come on the list just by virtue of their officer roles. But in addition, all three of them are on the board of directors. And for that reason, I think they all have substantial influence over important decisions and would also be beneficial owners by virtue of the substantial control test. So my final answer is all three of them are beneficial owners. Let's change the facts just a little bit. In this case, Larry and Bill get 1,000 shares of common stock. Sally only gets 100 shares. Same senior officer roles as before. And again, all three are still on the board of directors. How does the outcome change this time? Well, first, on the basis of ownership, kind of obvious right now, Larry and Bill are definitely beneficial owners, but Sally is not because she is below 25%. On the basis of substantial control, Larry and Bill are by virtue of their senior officer titles, but Sally is not. So if that's all there were, it would just be Larry and Bill and not Sally. But because of the rule that we apply to board members having substantial influence on major decisions, I would still include Sally because she's on the board of directors. So in my view, the answer doesn't change. You still have Larry, Bill, and Sally as your beneficial owners. Same facts as before. Larry, Bill, and Sally each get 1,000 shares of common, but in this case, Blackbeard comes along. Blackbeard invests $1 million, and he gets 1,000 shares of convertible preferred stock. The convertible preferred is going to convert into common at a 1-to-1 basis. Let's assume that he has anti-dilution rights and accumulating dividend and all kinds of other stuff. And let's also say that Blackbeard has the power to appoint one member to the board of directors. Who are the beneficial owners this time? Well, in this case, because convertible instruments are treated as being converted, we're going to treat Blackbeard's 1,000 shares of preferred stock as if they were converted into common. After that takes place, all four of them have 25% or more, and all four of them are beneficial owners. Looking at substantial control, again, Larry and Bill are senior officers. Larry, Bill, and Sally are board members, so they would come in on that basis. Blackbeard has the power to appoint one person to the board. Now, if you remember that definition of substantial control, I'm going to go ahead and go back there just for fun. There we go. I just flew right by it. Substantial control, there it is. Subsection B, an individual has substantial control if they have the power of appointment or removal over any senior officer or a majority of the board of directors. So Blackbeard's power to appoint one board member, that by itself would not make him a beneficial owner. However, if Blackbeard appoints himself to the board under my rule of substantial influence, I would include Blackbeard on that basis. Let's imagine Blackbeard appoints his friend Bluebeard to be on the board. In that case, I would also include Bluebeard on my list of beneficial owners. So as you can see, some small changes can result in some significant differences at the end. I'm going to take a moment here and address a couple of the questions that came along. So someone has asked about the rule involving inactive entities. If an inactive entity is owned by a foreign person and therefore not exempt, how far back does FinCEN go based on the company's formation? Okay, I think you're confusing a couple of the different aspects of the inactive entity exemption. We didn't go into that in depth here. Let me flip back real quickly to the tab that includes all of the exemptions. You'll remember that there are 23 different categories of exemption, the last of which is inactive entities. There are, I think, 6 different requirements for an inactive entity to be exempt. One of them is that the entity has not had any changes of ownership in a certain period of time. The other is that the entity was in existence before January 1, 2020. And there are a couple of other requirements as well. Again, crack open the regulations to see what the requirements are. The question is asking if the inactive entity is owned by a foreign person and not exempt, how far back does FinCEN go based on the company's formation? At that point, how far back to go is not really the question. If an entity that would otherwise be inactive and therefore exempt is owned by a foreign person, it is not exempt. So if the exemption is destroyed, the entity is a reporting company, and it's going to have to report everybody, and there is no going back to calculate. If one element of the inactive exemption fails, the whole thing fails, and the entity is not exempt. I've gotten to the ends of the slides here. There are a couple of other questions. I want to go ahead and go through all of those. Someone is asking, what is the responsibility of the company applicant to ensure all beneficial owners file their reports? The answer to that question is nothing at all. Company applicants are not responsible to make sure that reporting companies file. If you crack open the regulations, go down to subsection G, 31 CFR 1010.380 subsection G. It is the responsibility of the senior officers of the reporting company to make sure that the reporting company files its report. If the reporting company does not, then potentially that's a willful violation on the report on the part of those individuals, and they could have potential criminal liability for it. But just because an individual was a company applicant, it does not give them any responsibility whatsoever for the reporting company filing the report. The same person asks, if a law firm is the company applicant and the company doesn't file, do they, the law firm, have any liability? So the answer to that is no. And of course, as we pointed out, the law firm cannot be a company applicant. The company applicant always must be an individual. So it might be an individual attorney at the firm who is a company applicant, or the individual paralegal, or the individual employee at the corporate service provider who could be a company applicant. But the firm as an entity, as a legal person, is never going to be the company applicant. And as I mentioned, law firms are not responsible for the failures of their clients who are reporting companies to file their reports. They could have a professional duty to advise their clients of the law, but under the Corporate Transparency Act, the responsibility for filing the reports is something that rests on the shoulder of the senior officers. Now, as this slide points out, we've already talked about the fines, the penalties. The responsibility lies with the senior officers, but there is also potential criminal liability for a person who provides false information, knowing that it's going to find its way into a BOI report, or who refuses to provide accurate information, knowing that it is required. So sometimes I get the hypothetical, we've got a handful of clients here in a reporting company, everybody is good to go, but one guy is kind of a nutcase and he doesn't want to provide his information. That's a problem. One of the things that you can use to persuade the non-compliant individual is that by refusing to provide information that only they have, that is required to make the BOI report true, accurate, and complete, that individual is putting themselves at risk of being liable for willful non-compliance. So the bottom line is that the senior officers are responsible. Companies need to get started now. Companies that don't need to file at the end of the year should look at their constituent documents and corporate governance to see that there are changes that they can make to make this process easier and more efficient. And lawyers and law firms who deal with small and medium-sized businesses should develop a system to go in an organized manner through their clients one by one in order to give them the support that they need to get their reports filed. And if you're interested in how you can use the FinCEN report filing system, please go to the chat and click on the link to request a demo, and one of my folks will reach out and show you how you can use the system. I've got a few questions here. Will reporting have any effect on tax reporting? Meaning, if someone is not an owner but has substantial control, could a taxing authority use the reporting of substantial control to argue that the person in fact does have an interest in the company? That's an interesting question. I don't think so. I'm not a tax lawyer. I'm a corporate lawyer that's studied up on the CTA, but there is nothing in the Corporate Transparency Act that amends the Internal Revenue Code. Even though FinCEN reports up to Treasury, and IRS also reports up to Treasury, FinCEN's regulations have nothing to do with the calculation of income tax. They should not have any effect on that at all. So I don't see that as being a very likely risk, and I haven't come across that one before. Okay, the dissolution question. This one comes up every time. If an entity was created, the question is before January 1, 2024, but forget about creation date. If an entity is dissolved in 2024, does it still have to report? If you want to read the full analysis, go to fincenreport.com, click on the blog, and I wrote a detailed analysis of this question a couple of weeks ago. It's called Dissolution in the CTA. The answer, I think, is if an entity is fully and finally dissolved before 12/31/24, so that it does not exist as a matter of state law, I believe that entity does not need to file. Now, that conclusion is not entirely free from doubt. There is some dicta in FinCEN's 2022 release of the final rule that suggests that they aren't entirely clear. I think that I've got the better solution on that, because if an entity does not exist as a matter of state law, then it is not, by definition, a reporting company, right? Reporting companies are corporations, LLCs, and other entities. If there is no entity there that legally exists, it's not a reporting company. Also, who files the BOI report for the reporting company? Well, it's the senior officer. Well, if the entity is dissolved as a matter of state law so that it does not exist, it doesn't have any senior officers. Therefore, there's no one who can testify that they are authorized by the corporation to file. If you can't file, you can't file. Now, as I mentioned, this conclusion is not entirely free from doubt. I have written to FinCEN and asked them for clarification. I am eagerly awaiting their reply, and I will let you know when I get it. I'll post something on the blog. A question here, can a lender have substantial control? Great question. The answer to that question is no. There is actually language in the regulation itself that lenders who are exercising the normal sorts of rights that you see in loan documents and collateral documents do not exercise control. A person is not a beneficial owner solely by virtue of their interest as a creditor. However, a lender who has both an interest as a creditor and also some other form of interest in the company, perhaps they have a board seat, perhaps they have warrants that are a convertible security that could give them an ownership stake. In those situations where there are non-creditor related relationships involved, there could be a lender who has substantial control. You would need to look at the facts. Someone asks, as it relates to getting access to the BOI data that FinCEN has in its database, one of the requirements of the proposed access rule is that the bank or the financial institution will have to get the consent of the reporting company to view their data. And the question is, how are banks going to get that consent? Great question. We don't really know. That's something that FinCEN is supposed to be focusing on in their access rule, which is not yet complete. I can tell you that companies like FinCENreport.com are going to have products like that available for banks that would allow banks to securely obtain the consent of the reporting company through our system, see the report that we filed for the reporting company through our system, and thereby bypass a lot of the regulatory issues that FinCEN would apply through its access rule. So there's a question about FinCEN identifiers. Okay, so there's a thing you can get. You can go to fincen.gov and follow your way through their website. And as an individual, you can apply for a FinCEN ID. It is a number with 12 digits in it. And if you then are required to provide your information to a reporting company, either because you're a company applicant or you are a beneficial owner, you just give them your 12-digit FinCEN ID. If you do that, you have satisfied your obligation as an individual. The reporting company is able to report your FinCEN ID in place of your name and information, and that satisfies the obligations. However, realize that when you apply for a FinCEN ID, you are taking on a lifetime obligation to keep your information up to date in your FinCEN ID application with FinCEN, not with my company, with FinCEN.gov. What that means is if you move, you got to tell FinCEN. If you get a new driver's license or passport, you got to upload it to FinCEN. So all you've really done is shifted that aspect of the compliance from the reporting company to yourself. So for that reason, well, that's one of the reasons why people use FinCENreport.com. You can have all of your data in your personal locker in our system. That's all free for you. And then you can connect your account to the reporting companies. You're never going to have to personally log into FinCEN.gov. You're never going to have to apply for a FinCEN identifier. Oh, two great questions here. Do DBAs on record with a county, but not an LLC and not part of an LLC, does the DBA have to report? I'm not completely sure what you're asking there. If you're a reporting company, you report. If you're a reporting company with a DBA, you have to disclose your DBAs. If you are a sole proprietor, and therefore you're not a reporting company, it doesn't matter if you have obtained a DBA for your sole proprietorship. You are still not a reporting company and do not have to report. Another question here, this will be the last one. If an entity has an investment advisor or manager that by contract controls investment decisions, is the investment advisor a beneficial owner by virtue of substantial control? Quite likely. I would need to know all the facts in order to give you a full answer, but that's exactly the sort of arrangement that FinCEN is looking to figure out and collect hold of as it relates to the beneficial ownership reports. So you're going to have to dig into the facts, crack open the regulation, and figure that one out, quite possibly. So thank you very much for your time here today. That is the end of the presentation. Again, I encourage you to consider using FinCENreport.com as a tool to help you in your law practice, keeping information confidential and secure as you guide your clients through the compliance process. I'm Jonathan Wilson. We'd love to hear from you, and best of luck with your compliance exercise. Thank you.